So welcome back to chapter 2. We're going to dive right into doing all of the managerial accounting stuff, looking at a job order costing system. I will tell you, we're going to start doing a lot of journal entries in this chapter. So if you don't remember journal entries from when you took financial accounting, I do again encourage you to go back. You have the ebook in my accounting lab. Go back to those financial accounting chapters, specifically chapters 2 and 3, and really review those normal balances and how to do a journal entry and how to post to T accounts. So hopefully you've printed out the handouts also. You've got those because I'll have set up again a lot of the information and then you'll just fill in the journal entries below. I would also encourage you to grab a separate sheet of paper, maybe just a big blank page where you can draw all of your T accounts on it. So if we were in a classroom right now, we would be doing the journal entries on the slideshows, and then on the board, I'll have written out all of the T accounts so that by the end, we'll have our T accounts all completely filled and you can see them flow through. In fact, for those of you who really like to color code things, I tend to color code things in this chapter by color so we can see the materials cost as they flow through and we can see the overhead cost as they flow through. That's certainly not necessary, but I would encourage you to get that. You have your notes and then you have that separate sheet of paper where you can draw all of the T accounts as we go through these. So first of all, before we get into those, we need to have a discussion about job order and process costing. So there's two different types of costing systems that you can have in a manufacturing setting. Which one you use depends on what kind of product that you make. So we're going to cover job order in this chapter. We'll cover process costing in chapter 3. So the cost accounting system is just the way that we measure, record, and report our product cost. It's really important that we know what our product costs are. How much does the product cost us to produce? We need to know this so we know which products to produce. So those of you that have taken economics, you've talked about marginal cost and marginal revenue. You've talked about that production possibilities curve. Where do you need to be along that curve in order to maximize your profitability? You need to know what the cost is in order to calculate that. This is where you get the cost. So we determine the cost, we give it to the economist, and they make those decisions as far as which products we're going to produce, how many of each products we're going to produce. We most likely use a cost plus pricing model to set our sales price, so we need to know how much a product costs in order to set the appropriate sales price. And then we also have to know what the accurate product cost is, and this is where GAAP comes into play because this is the number that we're going to use to debit cost of goods sold when we sell the product. This is also the cost that we're going to use when we're determining what is the balance and ending inventory on the balance sheet. We've got to use this particular cost number. So if we are a company that mass produces identical goods, then we will use a process costing system. So I realized I jumped out of order there, but a process costing system is when we mass produce identical goods. So if I'm Coca-Cola, I'm making batch upon batch upon batch of cans of Coke. They're all exactly the same. They never change. They shouldn't change. They use a job order cost system. If you are Kellogg's and you make cereal, every box of cereal that you make for this Fruit Loops or whatever is every box of Fruit Loops is exactly the same. You're using a process costing system. But if you're a company that makes specialized, customized products, usually we would process these by job, we would have a custom job, then we're going to use what's called a job order costing system. So I have a friend who owns a print company. She makes designs and prints things like custom invitations, menus for restaurants, signs for your yard, like if you're running for political office and you want signs to put up in your yard. If you have a small business and you want a sign to hang out front advertising your grand opening or a sale or something, she custom designs all those for you. She has a job order cost system. So she's going to calculate a cost per job, and then there's a selling price per job, and so she'll have profit per job. Now, you may be making one unit, you may be making a whole batch of units, but we're pricing it per job as opposed to what we're going to do next week in the next chapter where we price it by step of the process. So we're going to start right now going through those journal entries of a job order cost system. Now, before we do that, I just want to do a quick refresh on how to properly and correctly write a journal entry. So first thing, remember, is when we write a journal entry, the account to be debited goes on the first line. So I'm just going to write a sample one right here. So the account to be debited goes on the first line, and the amount that we are debiting that account goes in the first column. The account that we are crediting goes on the second line, and we indent. So we would, for example, credit cash perhaps, and then we put the amount in the second column. Remember, when you're looking at a T account, the left side is called the debit side and the right side is called the credit side. Certain accounts have a normal debit balance, meaning they get increased on the debit side and decreased on the credit side, and certain accounts have a normal credit balance, meaning they get increased on the credit side and decreased on the debit side. There's lots of mnemonics that you can use to help you remember the normal balance of different accounts. There's one about elephants eating rowdy children or something like that. It's very disturbing. The one that I teach, so if you took me for financial accounting, this should sound familiar. We use one called Aid Reveille. Aid Reveille. And there's a whole story behind this about A&M's football team and Reveille being the mascot, but that's a D. It's really hard to read. But what it comes down to is that assets, dividends, and expenses all have a normal debit balance. They get increased on the debit side, they get decreased on the credit side. Revenues, the O stands for owner's equity, which is common stock and retained earnings, and liabilities all have a normal credit balance, which means they get increased on the credit side and decreased on the debit side. So if I receive an asset or I buy a new asset, I want to debit the asset. If I spend money or I use up an asset, I want to credit the asset. Now, we said that expenses are always debited. It's very rare that we credit an expense. Revenues are always credited. It's very rare that we debit a revenue. Liabilities go both ways. So they go up on the credit side if I incur a debt. If I pay off that debt, they go down on the debit side. So again, just a quick review. Again, hopefully that has refreshed your memory, but if not, I encourage you to go back and specifically review chapters 2 and 3 of your financial accounting textbook. So in a job order cost system, we're going to keep what's called a job cost record. You may not formally call it that, but that's really what it is. It's where we're going to keep track of all the direct materials that we used, all the direct labor that we used, and all the overhead that we applied to this job. So we have an example of a job cost record here that Smart Touch Learning did for Central College Bookstore, where they built, they manufactured, they produced 15 tablets with their custom e-learning software on it. So we're going to go through the journal entries and track how we came up with this job cost record. So want to point out just a couple of things. For every job that we're working on, we're going to have a job cost record, and that job cost record keeps track of the materials, labor, and overhead for that specific job. Now, usually as a company, we're going to have multiple jobs that we're working on. So we're going to have multiple job cost records. We have, in this example, we numbered them, job 27, 28, 29. You may choose to name them a different way, but you've got multiple job cost records. So your work in process account is all of the jobs that you're working on. And these jobs make up what we call the subsidiary ledgers of the work in process control account. So the work in process account is what we call the control account. So the idea is work in process is all of the jobs that I am currently working on. So if I want to know the balance in work in process, I would add up all of the job cost sheets. So the sum of the subsidiary ledgers equals, there's an E in there, the balance, the total in the work in process control account. So the rule is every time you put something into work in process, you have to also put it in a job cost sheet. Every time you put something in a job cost sheet, you also put it in work in process. And then when we finish the job, we'll move the whole job cost sheet out of work in process into finished goods. So here we can see in this example, we finished job 27 and 28. We moved those out of work in process into finished goods. We know exactly how much to move out because it's the total of those job cost sheets. And then in this case, the thing that's left in work in process is job 29. That's the thing that we haven't finished yet. That's what's still in work in process. And then when we sell a job, we'll move it out of finished goods into cost of goods sold. So now all of those costs become an expense. And here we can see the thing that's still left in finished goods is job 28. All right, so hopefully you've got your separate sheet of paper there, and I would encourage you to go ahead and make 3 T accounts right up front. Make your raw materials T account, and it has a beginning balance of $70,000 in it. So those are materials that we bought last year. We're starting over January 1. Those materials that we bought last year but didn't use. We're going to use them this year. Our work in process T account has a beginning balance of 80. Those are jobs that we started last year. We haven't finished them yet, but we're going to finish them this year. And then finished goods was 0. We had sold everything we made last year. We had nothing that was sitting on our shelf waiting for the customer to pick it up. So it had a beginning balance of 0. So as we go through these, you're going to do 2 steps. You're going to write the journal entry down. And again, I'm encouraging you to print those notes and write those journal entries right there in the notes. But then you're also going to post to the T accounts. Don't forget that second step of posting to the T accounts. That's very important. So here we purchased raw materials of $367,000 on account. Remember, on account means we didn't pay for them. We said put them on our bill, we'll pay you later. So on account gives us 2 options. It could be accounts payable or it could be accounts receivable. So we have to first of all think, okay, is this money that I'm going to receive or going to pay? Since I'm purchasing materials, this is money I'm going to have to pay. It's not accounts receivable. So we're not going to use accounts receivable. We're going to use accounts payable, which is a liability. So raw materials are an asset. I have more assets now than I did before. So I want to debit the raw materials account. That means I have to credit accounts payable. Accounts payable is a liability. Liabilities have a normal credit balance. Since I have more debt now than I did before, it would make sense that I want to credit the liability account to increase it. So I'm going to write my journal entry to debit raw materials, inventory, credit accounts payable. And then we're going to post this to our raw materials account. So notice your new raw materials T account down here at the bottom. It's not don't draw a new T account. We're just showing you what it looks like after you've posted it. So you've gone into raw materials. It had a balance of 70. You're going to add 367 on the debit side to it. Now technically, yes, we have an account payable T account over here that we're going to credit for $367,000. It's not really germane. It's not the focus of our intention here. So a lot of times we kind of ignore that. But just to be complete, let's go ahead and draw a little accounts payable T account and credit it for 367 also. Now, transaction two, we're told that we used some materials. So we had bought all these materials, they're sitting in our warehouse, we go and we get them and we use them. So we're told that we used direct materials that had a cost of $355,000, and then indirect materials cost $17,000. So remember, direct materials want to go directly into work in process. So we want to debit the work in process inventory account to increase that. The indirect materials have to go through overhead. So we'll want to debit overhead for that 17. And then we'll credit raw materials for the total. So remember, work in process is an asset. We are debiting work in process for the direct materials amount. We are debiting overhead for the direct materials amount, so we're increasing both of those accounts. We are crediting raw materials inventory, which is an asset, so we're reducing it. We're saying, hey, we've used these materials now. They're not sitting in overhead. Now, before we go any further, you want to go ahead and post this entry. So you already have your work in process T account drawn. You want to put the 355 on the debit side. You probably don't have an overhead T account drawn yet, but go ahead and draw one and make these fairly big. We're going to use all these a lot. Make these fairly big and debit it for 17,000, and then go to your raw materials inventory T account and credit it for 372. So after you've done that, you should see your T accounts look something like this. So our next entry is we're told that labor costs were $197,000 for the year. $169,000 of that was direct labor and $28,000 was indirect. So we learned back in financial accounting that when we pay wages, when we pay for labor, we would debit salary and wage expense. We would credit salary and wages payable. However, these are now product costs, not period costs. So we're not going to debit an expense. We're going to debit an asset. Remember, the direct labor is going to go directly into work in process, so we'll debit work in process for the 169. The indirect labor has to go through overhead, so we will debit overhead for 28,000, and then the credit stays the same as it always did. So we'll still credit wages payable or salaries payable for the total of 197. So again, direct costs go directly into work in process. We're increasing that inventory account with a debit. Indirect costs go through overhead. And now we're crediting our liability to increase that liability for the total. Now again, you want to go ahead and post these. So you already have a work in process T account, so debit that for 169. You already have an overhead T account, so debit that for 28. And then we'll draw a little wages payable T account over to the side to credit for 197. So our T account should look something like this. We've got our wages payable credited, and we've got our work in process debited and our overhead debited.